Good afternoon and welcome to HAR Community Conversations. We are here every month to have meaningful conversations about topics that matter most to Houstonians. And with that today, we are pleased to be joined by Jesse Thomas. He is a senior business economist with the Federal Reserve Bank of Dallas, Houston branch. Welcome to the program, Jesse.
Hi, thanks for having me.
Thank you so much for joining us. I know we have a lot to talk about today. You're going to give us a good overview of the economics of the Houston region and also give us a little bit of insight into interest rates, which we know is very important to consumers in the Houston area and across the country. Before we get into everything, though, please tell us a little bit about yourself, who you are, and what you do.
Thanks, Christina. My name is Jesse Thompson. I'm a senior business economist here at the Houston branch of the Federal Reserve Bank of Dallas. So I do still live in Houston. I was born and raised here. I went to the University of Houston, and most of what I do is I'm the regional expert focusing on our region's economy, but I generally specialize in oil and gas related and energy related issues. That's where I spend most of my time. But yeah, so I'm happy to be here and share what's going on in the outlook for Houston, and I'm looking forward to it.
Thank you so much. Now, many people may hear the terms Federal Reserve, but not really know what the Federal Reserve does exactly. Can you explain the Federal Reserve's goal and how it supports the U.S. economy?
Sure. And I don't think you need to qualify it with many. I think it's fair to say most people have no idea what the Fed is or what it's up to. So the Federal Reserve Bank is the central bank of the United States. We're actually the third central bank that the United States has had. And our mission is to promote economic and financial stability. So, we want the economy to sort of not run too hot and not run too cold, or at the very least, use monetary policy to make sure that, we don't have, massive crises or try to limit the extent of the damage that happens. But that also sometimes means taking some of the punch away at the party, when the party's getting a little too hot, mainly inflation. So our main things that we do for that, we conduct monetary policy. That's the most visible thing. Every 6 weeks, 8 times a year, the Board of Governors in Washington, D.C., and the district presidents who are scattered around the country at the 12 Federal Reserve Bank districts, they get together at this thing called the FOMC, the Federal Open Market Committee, and they set monetary policy. They raise or lower interest rates, and there's a number of other things that the Fed does with respect to that. But that's the thing that people are most familiar with. That's what they see on the news and talked about endlessly. Now, we have other responsibilities as well. So the Federal Reserve System is responsible for banking supervision and regulation. So making sure that banks are sort of obeying all the rules and not being too risky. Because a big chunk of making sure that we've got financial stability is making sure that there are no bank failures. The part of the reason for the creation of the Federal Reserve Bank, and I mean that federal in a very literal sense, was because we had serial bank runs and crises and financial crises, major recessions during the period where we didn't have a central bank in the late 1800s. And some people got together and decided, we got to have something better than what we're doing, because what we're doing is not working well for anybody. And so we came up with the Federal Reserve System. And now when I say federal, I do mean literally federal, and that there is a central body in Washington, D.C., that's the Board of Governors, and with separate voting powers at the FOMC, independent voting powers, we have the district presidents. And they get around the table and they all have, equal ability to influence the monetary policy decisions of the Federal Reserve System. So when we say federal, it is literally federal. You can take the debates on how the system is structured all the way back to Hamilton versus Jefferson. Lin-Manuel Miranda is a nice shortcut, but there's a lot more to it than what he managed to get into his play. Within that, the other thing that y'all probably hear the most about is, or maybe you don't hear anything. Hang on a second, I'm getting ahead of myself. So banking supervision and regulation. Sorry, sometimes the spirit takes me and I just start going off on a little side conversation. oversee the payment system. So a lot of people don't realize that the back end of the financial system, as money is flowing from one place to another, is that we actually do a lot to make sure that that is functioning smoothly, that we are a first line of defense for identifying fraudulent currency and working with the Secret Service in that regard, because we move all the money around. And, for many of you who, remember, for the few of you left who apparently every year still watch It's a Wonderful Life, we try to make sure that banks never run out of money, when there's people are demanding currency. And in particular, of note to us, we moved a lot of currency here in Houston during, Katrina, Rita, Harvey, because, electronic payment systems were down. People needed cash, and the Fed had to run cash trucks to make sure that because the demand for cash, for currency, was way up during those periods. So, that's a big part of what we do. And then, of course, consumer protection and community development. We want to make sure that we're meeting all of our obligations and doing our best to make sure that we have a smooth running economy and that we all get to participate in it. The shorthand for that is full employment and stable prices. This is what we call our dual mandate. It's the core of what informs what we do with monetary policy. And that dual mandate is, we don't want inflation to be out of hand, but we also don't want, in the short run, we don't want people to be, unemployed. We want, kind of have a best of both worlds if we can. And that's what the Fed tries to do. That's our mission.
Very good. Thank you so much for that explanation. Now let's talk about the economic outlook for Houston. Just if you could give us a brief overview. I know there's a lot to it, but if you could give us a brief overview for our viewers, the general economic outlook for the Houston area.
All right, the short version. Houston's in great shape. We're data that we have right now and the modeling that I do. We're on track to add somewhere around 70 to 80,000 jobs December to December this year. That is above trend. Something closer, a little less than 60 would be sort of like trend growth. So we expecting very strong growth in the Houston market. And when I say Houston, I don't mean city of Houston, by the way. I should clarify. I mean the metropolitan area, the 9 county area. So Houston looks really, really great. The U.S. economy, the data is coming in strong. And yes, Houston, we very much have to pay attention to the macro economy. It's not just about oil and gas like it was 40 years ago. The macro economy matters. But the U.S. economy is looking really, really good. Unemployment is low. Core inflation is slowing down. When we look at our region, the exports are really strong. The Port of Houston is, they're not seeing the peak levels of activity that they saw, 2 years ago, but, activity is really, really strong. And our energy industry, which is still sort of the biggest horse at the trough, hoss at the trough, but not as important as it once was, not as central as it once was. Energy industry is on firm footing. The energy sector is on firm footing for slow, steady growth.
That's great. Not
wild upswings, not wild downswings, and that makes it a little bit easier for us to plan ahead in Houston if we're not going to be swinging around. But put that together, we've got a really solid outlook for Houston. And in fact, I'll even just say the statewide, we're forecasting, almost 2.5% job growth this year. So just a very healthy outlook for our region.
Excellent. Well, you give us a little bit of the national perspective, but I'm curious how Houston compares to maybe other major metros throughout the country.
Sure. Well, most of my time I spend looking at Texas and Texas metros. But Houston, I would say, relative to other large metros around the country, again, we're probably going to outperform. We generally have what we call a growth premium over the job growth that happens elsewhere in the country of anywhere from the other major metros on the east and west coast. You're talking maybe 0.5%, but nationally, like what percentage point average growth premium. So we tend to grow about full percentage point faster than the nation, and we focus on job growth. That's what I'm talking about when I say growth premium. Job growth tends to be about a full percentage point faster here. Now, our unemployment rate is higher here than it is at the national level. And that's a lot of people are going to see that in the monthly data. Turn on, whatever your preferred news channel is here in Houston, because I'm sure you all watch local news. The unemployment rate does tend to be higher here. We're running around 4.5. It varies and it gets revised because for a variety of reasons. But the reason why our unemployment rate is typically higher than the national employment rate is because our labor force actually has been outpacing, has been growing faster. And when the labor force grows, it tends to put upward pressure on the unemployment rate. And so its unemployment rate is higher here than the national level, but it's for good reasons, because people want to get a job here and they don't just show up with jobs all the time. And that kind of keeps the unemployment rate at a little bit higher level.
Okay, thank you so much. So based on your outlook, what are the implications for commercial and residential real estate sectors?
Okay, so it's a bit of a mixed bag. Obviously, there's a lot going on, and that's a big basket of stuff there, commercial and real estate. So, I mean, first off, just say the single family market. Existing home sales, the homes that are already built and that somebody already owns and has been living in, that remains suppressed by high interest rates. So if you look at pre-pandemic or just to get an idea of what was normal before everything went wild, pre-pandemic, we're well below that level of sales. And bear in mind, we've added a lot of homes and we've added a lot of people. So the total number of home sales suppressed by high interest rates. Particularly mortgage rates have been as high as 8% last year. So that's the case. Now we did get a drop in interest rates last fall. And with that, we did spur some extra sales. So the 2024 existing home market, we saw some improvement in sales, improvement in listings. People kind of came off came off the sidelines and decided to sell their house. But it is still a low level by any historical standard. When you look at new home sales, though, new home sales are very healthy. We've been building some new homes. There was a pause in construction during the pandemic because of all that, but they're playing a little bit of catch up. But new home sales are strong. They're running at about 25 to 30% of all home sales, which is a huge share. And the way that this is happening, despite high interest rates, is that builders, especially those with really good financial positions, builders are buying down rates. They're buying down rates, or they're offering refinance opportunities where, all right, we're going to sell you this house, but a year from now we'll have a no-cost refinance or some other time frame or some other strategy. But all it boils down to is that the builder is subsidizing the purchase through the mortgage deal. That's what's driving that to be so strong. Plus, of course, population growth. A lot of people come in here, and we need more housing for all those people. So it's still very expensive to rent a U-Haul from anywhere else in the country and bring it to Houston versus renting a U-Haul in Houston and taking it anywhere else in the country. And lastly, I want to say, permits for single family construction, the pipeline for new housing, because we do need to build more housing for all these people. Single family construction permits, they are maybe a little bit low for where we would have been had we stayed on trend with where we were for right before the pandemic hit, but we're growing at a faster pace than the nation. So you're seeing it's relatively easy to build here compared to most other metropolitan areas, which is one of the reasons why Houston has remained relatively affordable as a major city, because when people line up to buy a home here, we will build them a home. And it's relatively easy to do that here. Now, we might build that home in the middle of a flood reservoir, and at some infamous cases. But you see, you see the construction being relatively high here. Multifamily market, massive surge in construction for multifamily nationwide. The Texas Triangle, that I-35 corridor, had it really bad, especially in Austin. Houston, not as much. We didn't see as high rent growth in Houston in the multifamily market, and so we weren't in a shortage at the start of this pandemic, like a lot of other metros were. We had actually already overbuilt before the pandemic, and so we didn't quite have the run up in rates here that we saw, say, in Austin or Dallas or San Antonio. But and thus we are not seeing as weak of a decline in rates, but we are seeing declining rental rates for apartments right now. And there's just a slew of construction. Last year was a record year for new apartment units being delivered. And this year is going to be a new record for a number of units delivered. And what happened to my phone there? I went sideways for some reason. But fun with technology. So when you, what in the world's going on there? So when you look at multifamily apartments, I don't know what's going on, why my phone turned sideways on me. The multifamily rents, they're falling. We're building a ton, but that's going to fall off sharply. So the construction is set to fall off a cliff here in the next year. And then we're just going to have a very loose market, negative rents likely through most of this year, negative rent growth in aggregate, with really the market not tightening up again until probably sometime closer to 2026, maybe in 2026. So that's residential.
Great.
I don't know if we want to.
Yeah, I'll give you a second to fix your phone there while I prompt for my next question. I just wanted to throw in a couple comments that I've seen come through. Sally says strong growth. And people saying good afternoon and thank you. A comment from Diane just saying great data, which of course we appreciate, again, your time here today. If you have any questions for Jesse, type those into the comments and we will get to as many as we can. So one thing that we've been hearing, or that we've been, I don't want to say promised, but we've been told, is that the U.S. economy, we expect a soft landing. Is that soft landing still on track?
So the soft landing, at this point, if you look at the consensus of forecasters out there, and I always highly recommend people, look, take lots of different forecasters, lump them together and see kind of what the average of the prediction is. You'll get a better prediction that way. If you look at the consensus of forecasts that are out there, we look at literally dozens. We aggregate, I think like altogether across a couple of different platforms, like 70 or 80 different forecasts. But you look at the consensus view of all these forecasts, no soft landing actually is the base case at this point, meaning that we just kind of we're slowing down to trend growth, and it actually kind of everything looks like we're just in we're slowing down to a normal expansionary period, is what the forecast is looking like. Now there is risks. There are sort of outside cases where you could say, maybe there is going to be a period of weakness or a modest recession in the near term. There's some things at the national level. And when I say near term, I mean within the next year and a half to 2 years. But as many of you may know, we've been, there have been forecasters saying that for about 2 years now, and they haven't been right yet. So eventually they will be right. In a long enough timeline, we will definitely have another recession, but it doesn't look like that's in the cards for 2024. It looks like slowing down to sort of a normal trend growth is kind of where we're headed, at least based on the forecasts that are available today.
Great. Thank you so much for explaining that. It sounds different than the information that we've heard in the past, which sounds good. But let's talk a little bit about interest rates, because we know that for any home buyer, this is something that they're thinking about. We see headlines about interest rates all the time. I'm curious, what factors are taken into consideration when decisions are being made about interest rates?
Sure. So the Board of Governors and the district presidents, when they meet around the FOMC, they are armed with reams of analysis and data updates. At every 8 weeks, every 6 weeks, they get together. They have this meeting, and they're looking at trends and the outlooks for the state of the economy. They're bringing regional perspectives to the table, because not every part of the country is having as good or bad a time as other parts of the country. And then they have to kind of ascertain whether or not the current stance of policy is appropriate. Do they say reduce accommodation? So if say interest rates are low, like they were, after the Great Recession, do you say pull your foot off the gas pedal? That would be raising rates from a very low level. Do you put your foot on the brakes, meaning you raise rates to a point where they start actually really constraining the U.S. economy, at least if everything is functioning the way we think it is? And that's sort of the deliberation. What data do they look at? So hard economic data, GDP, jobs, payroll jobs, unemployment rates. You're looking at layoff data. You're looking at financial data, information flows of actual physical cash. What's happening in the treasury markets. Hard data. That hard data isn't always readily available. Sometimes it's subject to revision. And to augment that, we add in survey data. Survey data is usually very timely. We look at, in Texas, we have the Texas Manufacturing Outlook Survey, which is, that's just a survey of businesses. We actually survey a lot more than manufacturing. We have like a half dozen surveys. But we ask people, is business doing better or worse? We ask them a slew of questions about business conditions and their expectations. Here in Houston, we're lucky. We're very fortunate. We have something called the Houston PMI, the Houston Purchasing Managers Index. It is one of the absolute best pieces of single data that anybody can look. Just Google it. You can find the report. It gives great real-time data about the Houston economy, the health of the Houston economy. I highly suggest you Google it. We also look at, we have things like the Beige Book, where we're collecting anecdotes from all over the country, and we're aggregating them by sector and saying, all right, well, what's happening in energy, what's happening in housing, what's happening in leisure and services and leisure and hospitality, staffing firms, all of it. And we aggregate it in sort of a loose sense. How are people feeling about the economy? Are things doing better or worse? What are they worried about? And if that's on top of, say, like we have a number of boards of directors at the local level with local leadership, local businesses tell us what's going on. We have roundtables, we have community outreach. We do a lot to try to see in real time how people and businesses, consumers and businesses in our community are reacting to what's happening. And then we try to aggregate that up to augment the economic data so that we have a fuller picture of what's going on.
Okay. Thank you so much for sharing that. So a recent statement or a recent announcement stated that interest rates would remain the same for the time being. With all that information that they're gathering, what will it take for them to cut interest rates again, do you think?
Well, I can't make a prediction on that. But as the data rolls in, we want to be more like, when it comes to interest rates, when it comes to inflation in particular, we want to be more like Wayne Gretzky in a hockey puck. For those of you who know what that means, we don't want to chase a hockey puck all over the place. We want to kind of know where it's going. And so as the data rolls in, the FOMC goes through that process of updating the data, updating the analysis, and they kind of see, all right, where is the economy going, and is it moving in the right direction? And as we progress down that path, if we've made that, they'll make that determination in real time. And it's not one thing; it's dozens of things that are all. Sometimes it's the unemployment data that's the most important. Sometimes it's home price information, home price data that's the most important thing. Sometimes it could be a dozen other things. Sometimes it's the oil market that's the most important. Of relatively higher or lower importance from quarter to quarter to quarter. So I can't give you a firm idea. This is what it is. This is what's going to happen. And when this happens, then they'll change. But it's a process, and they'll let us know.
Very good. You mentioned earlier that the current interest rates actually are low compared to some historic numbers. Can you tell us a little bit, dive a little deeper into that? What did you mean by that, and what were some interest rates that you were comparing to?
Well, I mean, the class. Obviously, interest rates are high right now, and if you look, if you're trying to buy a home, you're getting a mortgage, and you look at the chart, say, all right, where are mortgage rates today? They're higher than they've been at any point really since the 80s for most buyers, and that is a point where you actually had interest rates, falling down to this level, in the 80s. The interest rates for mortgages and generally, I would say across the board, across the stack, Fed policy too. We had higher rates in the 70s and 80s. We had much higher inflation that we were combating in the 70s to kind of get that under control. And so you were looking at, it's not uncommon for many Houstonians to remember, their dad or maybe themselves had their first mortgage on their home that they bought in Sharpstown in 1978 was like 16-18%, depending on where you were. And it was just an entirely different period of economic distress with higher inflation and higher interest rates required in order to move the needle on inflation back then. So we are very much in a different paradigm now, but again, higher than people have experienced at any point in a very long time, as where interest rates are right now.
Very good. If there are any questions for Jesse, type them into the comments, and we'll get to as many as we can. Kind of some foundation questions for us, if you don't mind, Jesse. Demetria was asking, she said, please, pardon my novice inquiry, but she was asking for just some quick definitions, if you don't mind. What is inflation and what is recession? They're commonly used words, and they mean different things to different people. So if you could kind of expound on that.
Absolutely. Sure, sure. So what is inflation? So inflation is the rate. So this is a thing that a lot of people confuse. These are great questions. Inflation is the change in the aggregate prices. So you think about the stuff that we all buy every day, or not necessarily every day, just the stuff that we all buy,
Mm-hmm.
groceries
Mm-hmm.
every day, gasoline, diesel every day, big screen TVs every couple of years. Your internet service provider, you might change that, every couple of years. All kinds of stuff, all the stuff that you buy. There's what we call it a basket of goods. If you're looking at, say, the CPI, the Consumer Price Index, basket of goods out there, you track those prices over time, and you aggregate them all together into this big data thing, and this one big data dump that we call the CPI inflation index, and it tells you the price level is rising or falling. Inflation is the change in the price level. So when we say inflation is high, what we're saying is that the price of the stuff, broadly speaking, is rising. That's it. That's what that means.
Mm-hmm.
And if we say inflation is falling, or if we say inflation is negative, then that would mean that price levels in aggregate are falling.
Mm-hmm.
Now, if we say inflation is slowing down, if inflation is slowing down, that would mean that the price level is growing at a slower pace.
Mm.
And so when we talk about we need inflation to come down, a lot of people hear grocery prices need to go back down, or whatever, but actually it doesn't. That's not what that means. What it means is we need inflation to slow down to a pace so that we can all catch up and kind of catch our breath.
Mm-hmm.
That wages and income can catch up to it for many people.
Yeah, makes sense.
That's what we mean by slowing inflation. Now, you also asked, what is recession? All right. Now, there is no hard and fast rule on what a recession is, but generally speaking, it is a broad-based downturn in the economy. It is often joined by falling prices, massive layoffs, so people losing their jobs, and a slower growth, even declines in overall economic output. In fact, most recessions have declining GDP. They have falling prices. They have rising unemployment. The stock market usually gets hurt, at least for a while. There's a lot of things happening all at once. And manufacturing output falls, all kinds of things. But it's not any one of those things. So that old saying, 2 quarters of negative GDP growth is a recession. That's not a recession. It was never a recession. No economics textbook ever said that's what a recession is. It is a rule of thumb. It is a quick sort of gauge. If you have 2 negative quarters of GDP growth historically, that meant that you were in or about to be in a recession. Because at the same time, lots of other stuff was also going in a bad way.
Mm-hmm.
But it's not necessarily the case, as we saw in 2022, when we had 2 quarters of negative GDP growth, but everything else was actually doing pretty good as we reopened from the pandemic.
Yeah. Okay. Thank you so much. Going back to inflation, really quickly, just a question, comment from Anu, I guess clarification. So inflation is basically the value of the US dollar dropping against the other major currencies?
Not necessarily.
Mm-hmm.
So inflation is the price of the stuff. Now, the price of the stuff can be influenced by the exchange rate. So, is the dollar strong or weaker? But so, for example, and what I say it's not necessarily the case. The dollar is very strong right now relative to other currencies. The demand and supply of dollars is affected by other factors that have nothing to do with what domestic prices are doing. So you could say, do other foreign banks or do other investors around the world maybe see the US dollar as a safe haven? Oftentimes that is the case, where they say, all right, we're going to demand some more dollars because we're in a period of economic uncertainty in my home country. That happens, and that can move the exchange rates. There are markets where currencies are exchanged and traded, because people are trying to find an arbitrage between the dollar and the yen, or the yen and the ruble, or whatever it is. They're making all kinds of trades, and those market forces can move the relative value of the dollar to other currencies, independently of what's happening here with our grocery bills.
Yeah, makes sense. Thank you so much. So, one question I have for you, because there is a perception that elections tend to influence the economy. We're in an election year. Do you believe that's true? And why do you think that perception exists?
Um, I think that the evidence is very thin that the elections have a significant effect on the economy in that year. And at least as far as directly. So there are some ways in which it can indirectly affect it. So obviously during periods of high uncertainty, where there's policy uncertainty, some businesses who are at the margin may say, you know what, I may delay making a particular investment decision for my business because I want to wait and see how the election goes out, how the election turns. So that can be something where there's a sentiment factor there. Like, all right, there's some uncertainty. I feel like maybe I'm going to hold off a little bit. That's one thing. And so certainly on that front, there's a way in which election years can have a semi-tangible effect, but the evidence that it's material, that it moves the needle in terms of the overall economy is very, very thin. I think it's overrated in part because it's just very visible. Like the election consumes our media and our public consciousness, during that year in particular, as we kind of hash out the different, political parties and advertisements, and people try to persuade us that, that we'll be better off if we go with this person or the other person or whatever. That doesn't really seem to move the needle. Now, it's important to remember that in terms of really moving the needle on the economy, there's a long road between the public discourse about changes in policy that an election might elicit and actually implementing a change in policy probably many years down the line. Very rarely, there's a long road between discussing policy changes and implementing policy changes, and a lot can happen along that road. So it's, and at the end, and then once it's implemented, oftentimes the macro effects of that policy take years to really accumulate or manifest. And so it's really hard to look at the elections and say, well, this is a major factor affecting the economy this year. There's just, I think, scant evidence. When you look at historically at elections, I'm not saying this particular election, but when you look at elections in general, they just don't seem to have, the election year doesn't seem to have the effect that commentary in the news media would seem to imply.
Okay, thank you so much. So, we've been talking about interest rates. Obviously, our audience is they're consumers, they're thinking about real estate, or we also have realtor members that are tuned in. What advice do you have for home buyers that might be on the fence right now because of where interest rates are at?
So great question. I wish I could advise everyone independently of what the optimal decision for them is. But, when you're making a big financial decision, if you're someone who's on the fence, if you're looking at these interest rates and you think, I don't know, if you're thinking to yourself, I really want to buy a house, but I also am thinking maybe I got to move out to Timbuktu to get what I want for, so I can have, I want to be in the suburbs, or I can drive farther now because I only have to go in the office 2 days a week. Whatever it is that's got you kind of rethinking your housing situation. If you're someone who's on the fence, the best advice I could give is to talk to a professional, find someone, a fiduciary, find a trusted advisor, a friend that you could, who's knowledgeable, that you could ask, hey, here's my situation. Do you think it's best for me to go now, to wait a year, to rent, to, what is it? Every situation is going to be unique. And so, there's a lot of great professionals at HAR amongst, there's a slew of resources available. The Dallas Fed, the Federal Reserve System, Google us. We've got tons of stuff on financial literacy and helping people make these decisions better. So that's my advice is, if you're on the fence, then your individual situation needs to be addressed by somebody who's really knowledgeable.
Very good. Excellent advice. Thank you. And we can post a link to the Dallas Fed's website in the comments as well, so people can easily access that. I'm glad to know there's some great consumer resources on your website. Jesse, you've shared a lot with us today. You've really helped, shine a light on this topic and help us get a better understanding of where we're at. Is there anything else that you want to share with our audience today?
Well, first and foremost, so I'd be remiss if I didn't let everybody know, say to everybody, go Cougs. Um, so, but yeah, yes, wonderful. They're really, we hit all the main topics here. When we think about Houston, and we think about sort of the strong outlook here, I want to impress upon everybody, the overall economic story for Houston remains a really compelling one. And I don't just mean right now or this year. I mean that the Houston economy has a lot of things going for it in terms of further economic development, long-term business growth. I know it can feel very sort of uncertain when you think about what's happening with the energy transition, and you think about, I live in Kingwood, and once again, flooding risk was brought front and center just very recently. We think about the long-term risks to the region. I think that those are challenges that we have the capability to rise to meet, but we remain a destination. People want to move here. They want to work here. Their businesses are relocating here. And I think, at the risk of being an advocate for my hometown. So yes, there's definitely maybe a little bit of a bias here, but I think that, there's a lot of room for our economy to continue to do well, and to grow and expand in a responsible way. That is really just good for all of us. So relative to the rest of the country, Houston, I think the long-term outlook for Houston is very strong.
Very good. A question that came in from YouTube: will this live be saved? Yes, but all of our live streams are saved. You can rewatch them from the very beginning, both on our Facebook page and our YouTube channel. And just a couple, good information coming in. Tina said, "Go Cougs." Jesse is awesome. Thank you. So definitely agree. Well, Jesse, again, thank you so much for your time today. This was really helpful. And that is it for today's HAR Community Conversations. We will be back next month, so be sure to tune in. Have a great week, everyone. Bye-bye.
Thank you.